Hello, everyone. Welcome to the stock-specific class here for Thursday, June the 9th. I assume that today's class is going to be pretty short just because nothing is really going to happen until that CPI number comes out tomorrow. The market is just in this sideways range. But we'll go through it and look at the charts and see if we can anticipate what could happen after that report comes out. Before I get going, though, if you have any questions during the class that I don't get to or that you have during the week, make sure you send those to jerry@traderspro.com. So again, with the direction alerts, really it's the same. It looks pretty much the same as Tuesday. So I really don't want to spend too much time going through this stuff because it's just repetitive at that point. But we're still right in the middle on momentum. We're right in the middle on breadth. Sentiment is still in that high range. What this is saying is there's no extreme level. So we're not oversold. We're not overbought. Now all that really tells me is that we could go either way. So that's not very helpful. If I'm trying to anticipate what's going on. So I'm going to have to lean a little bit more toward the chart behavior, the chart patterns as to what I expect the market to do. But again, I need to emphasize this, that it's something I say all the time, and it's something I think we all understand, but sometimes we don't always believe, and that is that we can never know exactly what the market is going to do. And no matter what analysis we do, no matter how confident we are that the market should go up or should go down, the fact that we're in a marketplace, there's got to be uncertainty. There's got to be moves that are unexpected that take place that shock everybody. And it happens all the time. People have been in this business for 50 years, still get confused on moves that don't make any sense. The market is irrational. I would say most of the time it's irrational. And if you expect it to be rational, expect it to always move a certain way, I think that's the problem. You're expecting the impossible. And that's why, if you follow me for a while and you get a sense sometimes that I'm flip-floppy, I'm that way on purpose. I don't want to get too focused on or too biased on a direction to where I can't recognize a change in direction, because that could be deadly. I don't care about being a psychic or predicting things. I want to make sure I'm right. I want to be right about the direction of the market as often as I can. And that's going to be the key to making money. And as you can see over the last several months, that's been the key to the portfolio is that even though we've been whipsawing, we've had some steady growth there, because we've been able to use those inverse ETFs. So when the market does look like it's going to drop, we can make some money when it drops, and then when it comes back up again, we can make money when it comes back up again. We have that flexibility to be able to go either way. All right, buy-sell ratios, again, they're come back closer together with the selling over the last couple of days. You've seen a lot of these stocks go back from buys to hold. That's why you're seeing that buy line come straight down. Not too many going from hold to sell, though. So there's a lot in that hold range right now, which again means it could go either way. If I'm interpreting that, some sentiments right in the middle there, that sentiment indicator. So that's really not telling us much either. I got a question on options. I don't cover options in this class. I have an options class that I teach on Wednesdays. If you have that as part of your package or what have you, you could have access to that. And there's recordings that go with that talk about what I'd use to select strike prices, expiration dates, and things like that. And so if you could contact the office and they can give me more information on that. But I don't cover any options in this class. This is purely, it's a different type of trading here. I'm doing trend trading in this class. We're looking to be in trades for several weeks. as many of you can see with the portfolio we've been in for a number of weeks. I do jump in and out with those inverse ETFs, but I'm not. Trading options is almost a completely different approach. We're looking at very short-term indicators on the chart to make some of those decisions, and so it would be very confusing to try to do both in the same class, because if you've got someone brand new coming in, they're two different approaches. It's like trying to teach someone football and baseball in the same class that's never played sports before. It'd be very confusing because they're two different sports. Very distinct different sports. So anyway. So let's get into the chart here, or into the indexes here. And again, not much has changed since Tuesday. We're in the sideways range, but I get back to what I've said many times. Basic trend analysis. Whenever you see a stock moving sideways, you want to pay attention to the direction it was moving, and before it moves sideways, that's where it's more likely to go after it's done moving sideways. The way it's behaving right now, it's behaving that it's going to go up off of that CPI news. Now, that would kind of make sense in the sense of, from a probability standpoint, at least the way I'm understanding it. And again, I'm not a fundamental trader. I don't put too much emphasis on news or on opinions or on fundamentals. I focus on what's actually being traded on the chart. The chart is saying there's indecision because it's been moving sideways. But with the move before that indecision, I have a sense that professional traders are assuming that that CPI number is going to be okay. If it's a little high, I still have heard that traders will not overreact from a sell standpoint, because in other words, the view of a lot of these professionals is that the inflation is peaking, it's near the top. So if it's a little bit higher than expected, they'll still assume that we're near the top or near peak. So I don't think they'll overreact. If it's lower than expected, obviously that would be very bullish. It would take a number that's very high, above expectation, for the market to freak out. So in other words, we've got about a 2 out of 3 chance that number tomorrow is going to be viewed as being okay or fine. Maybe not great again, but we don't need great in the way the market's been behaving for it to go higher. We just need it to not be freaked out. And so that's how I'm interpreting this sideways move, and then the move before it. So let me go back up a little bit. So how I'm viewing this is, okay, we sold off through here. Something caused these, again, I'm assuming it's professional traders because they're the ones that move the market. Something caused them to buy up right through here. And so my assumption is that they assume that the inflation was peaking with whatever. Remember, these big institutional traders have their tentacles out all over the place. They're spending money to make sure they know information that you don't know. That they don't have to wait for that government report to know where exactly, or at least have a pretty good idea of where the economy is and what the inflation numbers are going to be. So they've got stuff out there. They're analyzing all this data out there. So they pretty much have a pretty good idea of what that report is going to show. So I'm speculating here. Of course, I'm not speaking that I know exactly what they're doing, but this buying right here was off of that expectation that inflation is peaking. Then we get up into this area here where we paused a little bit. And the first couple of days of a pause is not abnormal. That happens all the time within a trend, within a move. But a second half of the pause right here, I think, is just simply those professionals saying, okay, I've asserted some risk on this buying right here. Let's just wait. We got a few more days. Let's just wait till the actual report comes out before we decide to increase that risk to buy some more at that point. We bought ahead of it. Let's hear what it's likely what the actual report's going to be to decide what to do next. And again, I'm assuming based on the chart behavior that they're assuming that report's going to be two out of those three outcomes that would tend to be more bullish for the market. Now, I told you with the sideways ranges here that it doesn't mean that the market has to make a huge move up out of that sideways range. It's just that it will usually break that sideways range. So maybe the number is a little bit higher than expected, but not extreme. Maybe the market has an initial bullish reaction to it and then immediately freaks out and has a bearish reaction. That's a possibility. And so I'm not looking to load up on the bullish side, even if that number is not too bad. I still think that the market has that panic sell-off before we bottom. We're going to have to see it. I'm just, at least at this point, I'm convinced of that. Now we start getting up here, we're almost breaking out to new all-time highs. Okay, that we're going to have to shelve that expectation for a little while there because it could just put it off a little bit longer. But that's another thing is I'd rather just get it over with. That's human nature as well. We don't want to prolong the pain. We're in a situation right now. It's like, let's just get that panic sell-off over with so we can now start buying some stuff. Because so much stuff is way down, and we'd love to just get aggressive and load up on some trades to write it all back up again. But the market rarely does what I want it to do. So I'm assuming that it may not happen in the timeline that I'm expecting it. Now, is it possible that the market freaks out and drops? I've said that the reason why this pattern works so often is very rarely do you see tops that move sideways before going down. They're usually more pointy. Even right through here, you had two kind of pointy tops. You very rarely see a stock rally up, move sideways, and then come down. I call those volcano tops. They do happen. I could go look back and I could show you examples where it does happen. But if you were to do that, if you took the time and just went back and looked at couple years of charts on a stock or on the market, you'd find that it's very rare. It rarely happens. And so again, from a probability standpoint, you just got to go with expecting it to break out. Now, what throws this one a little bit what could throw this for a loop here is that we're waiting for, it's almost like an earnings report. You're waiting for a number that's either going to be bullish for the market or bearish for the market. That it really could go either way. So if you are going to have a situation where you have that volcano top and it drops, this would be one of those situations where you could get that, where you have this unknown event about to happen. I'm not overly, I hate being in that situation where I feel like I'm guessing, and as confident I am in the chart that we should go higher, it's still because it's based off of a known event that we know is coming. It just, I have a little bit of doubt in there that it could be one of those things that flips the other way, especially since I know that anyone that really knows anything about technical analysis, knows how to read a chart, understands this behavior. They're like me. They're saying this should go up. It should go up. And sometimes when, a majority of traders believe a move should happen, the opposite can sometimes happen. If you get too much of a bias in one direction, usually the opposite takes place. By the way, this is not just a market phenomenon. Have you ever seen, we'll take for example, it's been a few years now, but you remember the Super Bowl, if you're a football fan, the Super Bowl a few years ago, there was the undefeated New England Patriots who had just an offense that would dominate every team they played. They just destroyed every team they played. They were playing the New York Giants, who barely made it into the playoffs, where I think they were a wild card team in the Super Bowl. everyone just knew. Everyone was just like, hand the trophy to the Patriots. It's over. Everyone just knew they were going to win. And what happened? The opposite happened. They lost that game. I can't just to explain that phenomenon, but it happens all the time in sports where when the crowd gets too focused on one team, usually the other team win, or very often the other team can win. But the same thing happens in the markets, and so you start to develop just a sense of when everyone's. I think the stock's going to go up, and then you get a feel everyone else thinks it's going to go up. I suddenly start getting worried instead of getting excited, which would be normal for most people. That everyone thinks I must be on the right track. Everyone agrees with me, right? I tend to do the opposite, which is the opposite's probably about to happen here, and very often it does, and enough times where it's kind of scary. So again, if you're listening to my analysis here and you're thinking you're going to load up on the bullish side here, I just think that there is a little bit of a coin flip element going into tomorrow as to what could happen, and I wouldn't be comfortable betting heavy that it's going to go up, even though that chart pattern still looks pretty bullish overall. Now, another thing to keep in mind, too, and I don't know if I pointed this out on Tuesday or not, it could be that we stay sideways for a few more days because the Fed meeting is next Wednesday. So we could get a CPI number out and the market could have a reaction to it. And then the traders could immediately go, okay, well, let's wait see what the Fed does now. Are they going to be more aggressive? If it's a really hot number, maybe they want to see if they going to go with a 3/4 point rate hike instead of a 50 basis point rate hike. They've said that they're not going to do that. There's all kinds of things that could come into play over the next couple of days. You have Friday's reaction, then you could see the market just do nothing for Monday and Tuesday, and then Wednesday have that Fed meeting come out. Or you could see a reaction, maybe a move up off of Friday, and maybe what the Fed does could cause a reversal and cause the market to go down, or vice versa. You see a drop, and that could still be a correction here. If we saw a drop down into a lower area down in here on Friday, and then it pauses for a little bit and then takes off after the Fed. So there's a lot of outcomes that could take place over the next week here, and next Tuesday, and we'll be right before that Fed meeting. We'll have a better picture here of what some of those scenarios might be. And I talked about this before. When you have this real sideways, compact, corrective move, sometimes you can get you get a little dip below it to attract the buyers, and then it takes off. Again, that might be something that plays out over the next few days as well. Again, the other indexes look about the same, so there's not much to really add to that. This is a significant area, though. Let's go back to the S&P chart. This is a key support resistance area that we've been sandwiched in. So, if we get a significant break out above that, that would be, again, you don't want to see a close above that too. If it breaks out above it and fades into the close back down to that range, that would be a strong breakout. But, we can't, I don't want to underemphasize the importance of this range. It is important, and where it breaks is going to be something to pay attention to. All right, let's go on to the other charts here real quick. Bond market. Oops. That's not the bond market. Here's the bond market. We still haven't dropped. We've still been moving a little bit lower, but today, like it opened lower, and it's trading higher. I'm waiting to see if it breaks to a lower low. I think it should. This looks impulsive. This looks corrective. This is looking impulsive. I'm assuming it's going to break to a lower low. But I did talk about this on Tuesday, that if it did rally up and give you a higher low and then goes to a higher high, that maybe it'd be forming a little bit of a base for a reversal. We'll probably get a result on that one by Tuesday if it breaks lower or starts to move higher from there. Gold seems to be in a little bit of a sideways correction right here, which again would be a little bit more bullish because you had a little bit of an impulsive move up right there. So you see, whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's more likely to go after it's done moving sideways. And because gold is very tied into inflation expectations, this is one that's likely to move off of that CPI report as well, up or down. So just keep that in mind. Oil is continuing to trend up. It is getting into the extreme reversal risk range up here. So it's probably due to have a little bit of a consolidation or pullback. But that could still be a few days away. It could get even more extreme before that happens, but that's something to pay attention to. And we do have a lot of oil trades in the portfolio. Now the dollar, Tuesday I was talking about the possibility, this being a correction. You had a bearish reversal candle that we would start to head lower. I did mention that it could go up a little bit higher. Here's about a 50% retracement of that move down. Stocks will have a tendency to retrace about 50% of the moves. But if we get up above this area up here, you have to start to wonder if this is no longer a correction within a downward move. In other words, that maybe we aren't in a trend reversal in the dollar, that maybe this was the pullback and we're heading back up again. Those trend characteristics I talk about, impulsive, corrective, that stair step, this is the general pattern that most trends follow. When you're in a downtrend, it's an impulsive down, corrective, impulsive down, corrective. That's the general pattern, but stocks aren't, they don't have to always follow that pattern. And by the way, I look for stocks that follow that pattern. If I see a stock that does something like this, and it has no clear trend direction, it seems erratic, I try to stay away from that. It doesn't mean I don't trade. I can trade it on a very short-term basis where I'm just doing an overnight trade or a couple days, the trade for a couple days. But for a trend trade where I want to stay in it why would I even consider it? I mean, it's not. It doesn't look like it wants to go anywhere. It doesn't look like it knows where it wants to go. Why do I want to get into a stock that doesn't know where the hell it wants to go? And it's showing you it doesn't know where the hell it wants to go, So I'd like to try to find stocks that for the most part follow that trend behavior. But the point I'm trying to make here is that this although that looks impulsive to me, impulsive down, sometimes within that uptrend you'll get an impulsive move down that comes right back up and takes off again. And but again, if I'm going with pure trend behavior, that's impulsive. This is more choppy, more sideways. It's pretty obvious that's more sideways right through here. What should follow is another move down, another impulsive move down. And so that's what I'm still expecting. But like I said, if it starts to get up above that 50% retracement line, you have to start, looking at what it is actually doing. It's still going up. I can't ignore that it's still going up and keep assuming it's gonna come back down. It doesn't mean I have to trade it there though. It just means that's now it's decreasing the probability it's going to go down once it gets above that 50% retracement area. It makes it more likely that it's going to continue to move up, and then maybe you wait for it to actually break out to trade it or something like that. But that's when I would start to shift my expectations. The VIX has been relatively low. And that's another thing too, is that we've had some of these down days, but we're not getting any big spikes up in the VIX. So the VIX isn't telling us that we have to be concerned about these down days, some of these down days. Now, I expect that we're going to get a big VIX reaction tomorrow, up or down. If we get a really big spike up in the market selling off in a big way, then I think that's significant. That could mean that maybe we have a lot further to drop, and that we are going to get a downward move off of that. If we get a move up and the VIX drops down significantly, all that's doing is kind of confirming. Now, what would be weird is if you had like a big move up and the VIX moved up, or was flat, or was down just a little bit. That would tell me that the professionals don't quite trust that breakout or trust that rally. And it could be one of those things where it's breaking out, but the professionals might be waiting for Wednesday to see what the Fed is going to do. And so they're still hedging, or they're keeping hedges on just in case, and there's a reversal. So that would tell me if I saw something like that tomorrow, that would tell me to actually start looking for a bearish reversal candle, because it could drop. Or if you see it drop and the VIX doesn't spike up very much or move up very much, it could be a sign that there's the professionals aren't, the market's selling off, but the professionals aren't too worried about that sell-off, meaning that they think it's temporary. And going back to let me pull up the SPY chart again. That could so that if I saw something like that, if it moved lower and the VIX didn't spike up very much, that would tell me that this is probably just that ABC pattern, or that little dip out of that sideways move that I talked about earlier, and that it could start to rally off of that. And I'd be looking for a bullish reversal candle to maybe jump in and buy something there. Okay. I know this is a lot, and but this is what I do all the time. Is I've talked about this before. I like to run through scenarios. It could do this. It could do this. It could behave like this. Now, all this is tied into that trend behavior the basics, the fundamentals that I've taught you. What I'm trying to do is not get confused with what happens tomorrow. If I want to, it's like preparing for a football game. I want to try to study the team I'm playing and see all the plays that they run and the formations they get in, so that I'm prepared for what they're going to throw at me. It's not going to be something that's going to shock me that I've never seen before. At least I'm trying to do that. And then that way I can make adjustments, or I can know which direction to go in. So what I'm teaching you here is the real subtle ways that you can use the VIX in your decision making. I never want to make my entire decision on the VIX, what the VIX is doing. But the VIX can give you those little clues. Remember, the VIX is telling you the level of freaking out of those institutional traders. Are they freaking out a lot? Are they freaking out, or the opposite? They're complacent. They're not freaking out at all. They're freaking out a little bit. They're not freaking out very much at all. You're trying to gauge that with what you're seeing on the movement of the chart. And most of the time, it's not telling you anything significant. It's just telling you what you already know. Market moved up, VIX moved down. Market moved down, VIX moved up. But there can be little clues with how much. If you get a big spike in the VIX, a little move in the market, that could be significant. Or a big move in the market, a little move in the VIX. Either way, that could be significant. And it's just like gathering. You're a detective. You're gathering all these clues, and you're trying to come to a conclusion of who committed the crime. All right. SMH is actually looking more bullish here. You have any chip stocks you're looking at. That looks like you got impulsive. That looks corrective. You're sitting right at a key support resistance level. So what I'm going to do in the portfolio is I am going to add the SARK just in case we drop. I want to have some protection in the portfolio that can go up in value if the market goes down. I've got enough long positions, so if we go up, we should be fine. I'm not going to add the SOXS because the chip stocks still look very bullish to me. Remember, that one will go down if the SMH goes up. And so I'm not going to use that one just yet, unless this thing all starts dropping, the market starts dropping. I'll jump into that pretty quick to hedge our positions. Dow Transports, they dipped down a little bit today, but again, they were in that sideways range, dipped down a little bit. You have impulsive down and impulsive up. Corrective should have a move up. And as it relates to transportation stocks, I know this has a low strength rank, but there's some traders talking about Federal Express a little bit earlier today, and that's a pretty bullish pattern right there on Federal Express. You've got this kind of forming that bowl-shaped move. You're getting these higher lows right through here. You have impulsive up, and this is corrective, and you have a nice little bullish candle today. Again, it would depend on what the market does if the market goes higher, but this one is acting like it wants to go up. It's acting like it's reversing that downtrend into an uptrend. And again, you can see higher lows, higher high right here, potentially another higher low if we rally up off of that. Like I said, the strength rank is down at 42, so if you're trying to stick to those higher strength ranks, you might wait on something like that. But I just thought I'd point that out because we're looking at the transportation stocks. This is one of those transportation stocks, and then they were talking about it on CNBC today, and I just happened to look at the chart. I'm like, ugh. By the way, that's the advantage. I tell people all the time, never base a trade off of somebody that you're listening to on CNBC. All those people that show up that they're interviewing, they pay CNBC to come on the show. The reason why they do that is because many of them have funds that they run, and it gives them credibility. Hey, we're on CNBC. We were interviewed on CNBC. It's that kind of that street cred. Gives them street cred, so that when they're attracting new investors, they say, oh, well, they've been on CNBC, so they must be legit. They must be good. The problem is that their agenda is to attract clients. It's not necessary to make you money, and sometimes I've seen these people throw out stocks, charts they like, or stocks they like, and I've looked at their charts, and the charts are screaming that stock is going to go down. And I'm like, man, I always think about the people that don't know what they're looking for, that are listening to these people, and they're about to lose money just basing a trade off of what some clown says on CNBC. So on the other hand, I have no problem with them giving me ideas. There's tons of trades I've gotten where they've made an argument on a stock, and I'm like, oh, okay, I'll look at the chart. And I look at the chart, I'm like, hey, that's a good looking chart. And I've gone ahead and made the trade. Now, it had nothing to do with what they were saying. It had everything to do with what the chart was telling me. But if you get ideas from CNBC, that's fine, as long as you're doing your own due diligence and looking at the chart and analyzing the chart behavior. I mean, I don't care where I find stocks. I found trades in some of the most ridiculous ways before. Companies I'd never heard of before that I just say, oh, well, that's an interesting company. Let's go look at the chart. And, I found some really nice charts just in some random ways and have made great trades sometimes off of those. So I never question how people are finding their charts as long as they're doing their due diligence. Just never make a trade based off of anyone you hear on CNBC or anywhere else. Always look and do your own analysis. And if you don't know how to do it, then learn how to do it first before you start jumping in. Bitcoin, again, it's kind of stuck in there. And I talked about this on Tuesday that it could be that that's forming a base for a move up. It's already dropped a ton, but I'd have to see more of that behavior, more of moving up the right side of the bowl before I start making any Bitcoin decisions. All right, as far as the portfolio, I did get out of CF. Let me pull that up here. It did go below my stop. Why is my system here frozen up? Hold on, I gotta log back in. There we go. Yeah, it wasn't letting me type in a ticker. There we go, CF. So again, I had my stop on CF right below here. And we traded below it yesterday. I went ahead and got out. Now it has a little bit of a bullish reversal candle there, but again, that's where I determined I was going to stop out. I did. Could I get back in? Yeah. I could wait to see if this thing goes back to. Let me switch the signals on. It goes back to a buy signal. But I'm out of it right now. Stopped out of it. Now, I don't have a huge long position. In fact, let's take a look at the stocks I'm in. NOC had a down day yesterday, a little bit of a bullish reversal today. My stop, remember I moved my stop up below here, so we're getting pretty close to getting stopped out. Hopefully I don't, because I shouldn't. It should rally up off of that. The chart, the chart doesn't look broken yet. It still could, because if it rallies off of that, that would still give a higher low. It's still acting like an uptrend. But that's one that's getting close. And remember, where I moved my stop, this is above where I entered the trade. So if I get stopped out, I should still end up with it'll be a small profit, but still a profit overall. And I'm hoping I don't, because, even if I do get stopped out, I'd probably be looking to jump back in. I'm very, very bullish on these defensive stocks, aerospace defense stocks. In fact, I'll talk about one today that I like. Oil still moving higher. Again, I'm going to keep an eye on that extreme reversal risk. I don't really have any place to move my stop when it gets this extended, but I also don't want to hold this thing all the way back down. If it comes back, even if it comes back and corrects back down to where it broke out. So what I might do on this is use a technique where I look for a close below the low of the previous day. Notice how during this whole upward move right here, we haven't had a close below the low of the previous day. We were real close right here, but we haven't had a close below the low. Again, key, not a close below the close of the previous day, a close below the low of the previous day. Now, with this real compact day right here, any down day tomorrow would be a close below the low of the previous day, so I might go ahead and stop out. Now, that's a real. I don't like to use that technique until I'm in this extreme reversal risk, and preferably I'd like to be at the right side of that extreme reversal risk. So hopefully, oil. Well, this is the thing: is I really personally I don't want oil to keep going higher, because we all know how that sucks right now. But the trend is still acting like it wants to go higher, and hopefully you're making money off of the oil trade to offset the money you're spending in oil in your everyday life. But but I don't like to use that until you get in this extreme range, because when you're in this extreme range, you're in a position where you're more likely to get the bigger pullback when it pulls back. So now there are charts that can stay they can get to the right side of that extreme risk and they can stay there for a while. But you always have to ask yourself when you get in this position right here is like, you have to start to ask, how much am I willing to risk for that extra dollar a gain? Because you might be holding out for one more dollar gain, and then suddenly you get a $4 drop. So the chances of it going higher based on that extreme reversal risk are a lot lower. And when it does sell off, it starts to drop. It tends to drop very quickly. Here's an example right here. Look at for you wiped out 5 days of rally right here in one day. So I like to get out early if I can. I'd love to get a day where it closes just below there. And it doesn't go too far below there, but enough to where it tells me that it's closed below the previous day. I can get out. I've kept most of the profits on this move. And even if it did go up another couple of days before correcting again, that's fine. I'd rather get out, and rather than have a big drop in oil. And again, this is still possible because I'm still in the trade, but you get a big drop in oil that you get a huge move down on a day, and then you've wiped out the whole last week. You've wiped out the whole. That's frustrating because it's like I'm no better off today than I was 5 days ago. Now, again, you don't want to get out too early because this thing could really take off. And I've had that happen where I've gotten out early and it really took off, and I could have made a lot more money had I not used this technique. But most of the time, it tends to work in my favor. And so I'm not saying I use it all the time, but that is a technique you could use. But like I said, I usually don't use it unless I'm in that extreme reversal risk area where there's a better chance you'll get a bigger pullback when it finally does start to pull back. CEIX, a little dip today, but it came off the lows, a little bit of a bullish reversal candle today, had a bearish candle yesterday. So again, these are just real subtle things. Yesterday, I saw that bearish reversal candle. It's not shocking that it dropped down off of that. It's just I don't expect it. I still expect it to be in that uptrend. I'm not trying to jump in and out of this. But this gets back to short-term trades versus long-term trades. If I'm doing a short-term trade, I might do an overnight trade off of that bearish candle where I'm actually shorting the stock or buying a put option off of that, just trying to play that overnight drop that I'm expecting off of that bearish candle. When you're trend trading, you don't want to be jumping in and out because that's not the trading style. You're not going to be shaken out of that. I'm not going to get out just because I see a bearish candle. I want to see a break of the trend, and I'm not seeing any signs of that right now. Let me flip this back over to signals here. CVX, same thing. We got a lot of oil stock, although again, it's not all pure oil. That CEIX was a natural gas trade. ADM, again, it still looks okay. My stop is down below here. It still looks like it's moving up the right side of this bowl, possibly. It still looks corrected right through here. I don't see any reason to jump out of that. And again, what I'm going to add today is the SARK, S-A-R-K. Now, for those that might be new, there's a fund out there called the Ark Innovation Fund, ARKK. It's run by a woman named Kathy Wood. She gets into a lot of these stocks that she's expecting to be the next Netflix or next Microsoft or whatever, next Tesla, or actually she's in Tesla, pretty big, but she's picked these different stocks that are she thinks are going to be big in the future. She had a really good run up when the market was when it had all that easy money that was flooding into the market. But when as soon as inflation hit and nobody wanted to be in risky trades, she's been hammered here. So during this drop, there was another person that formed a fund that would do that shorted her fix. So doing the opposite of what she's doing. And he calls it the SARK, or they called it the SARK, SARK. Basically, short ARK is the acronym there. Doesn't have the extra K on it. It's just SARK. But this does the opposite of that fund. Now, why are we using this? Well, because it gives us a way where we can still be long. We're long the stock, but it's going to go up when the market is basically going down. When these riskier stocks are going down, this is going to go up. Now, what looks to me on this chart is it looks to me like this is possibly a bullish ABC pattern with a bullish candle today. It looks like this could go up. And this should go up if the market goes down. So I will be hedged a little bit if there's a negative response tomorrow and the market drops. This will go up, and hopefully this will offset some of the losses on those long positions on it. Now it could do the opposite, where if the market goes up, this could come right back down, and I'll jump right back out of it at that point. If the market's looking like it's going to go up, I don't need a hedge. I don't want to have it draining my account, losing money as the market's rallying. So I only use this when I think there's a possibility the market could drop or the market is dropping. And I use it as a way to hedge those other long positions. Now, those other long positions, I'm not going to jump out of it if I think the market's going to drop, because they've held up very well as the market has dropped. Oil stocks, heavy in oil stocks, heavy in defense. Those have still gone up even when the market has been going down. So it's been I know we're not making huge gains in the portfolio, but we are making gains in an environment where not many people are making money or they're losing money. And when you can do that, that's always good, because what we're trying to prepare for here is we're trying to prepare for that big drop, that panic sell-off. Then we're going to get in some positions we're going to ride up for a long time, and we're going to make a killing as they go back up. But the key is to not lose money until you've bottomed out, because you don't want to you want to have as much capital as you can to get in at that bottom. So I'm going to get into this trade. I waited till class because I wanted to be able to show some people that don't know how to add trades to the portfolio. Question: how does software determine buy, hold, or extreme? That's why you're subscribing to it. They're algorithms, and they're proprietary algorithms that are calculating anything that can mathematically calculate those conditions. That's what the software is doing, and it does a great job of it. Particularly for those that don't want to learn this stuff, learn how to analyze a chart. They want to green light means buy, red light means sell. They want a real simple approach. Those algorithms are designed to put them in the highest probability to get those positive results. But what I always tell people is, if you're willing to put the time in to learn how to read a chart, you're always going to have an advantage over someone that's just wanting a signal. And I'm assuming if you're going to spend an hour or 2 hours with me every week in class, that you're wanting to learn how to read this stuff and increase your abilities and give yourself a bigger advantage. And that's what the software can help you do. But yeah, I can't tell you the exact calculations of the software. Just like Coca-Cola won't tell me the exact formula for Coca-Cola either. So, all right. All right, so I'm going to put my stop on this one just below this line. Although really any sort of a bullish move in the market, bearish candle on this stock, I'll probably get out of it, even if it doesn't break below this. But I need to have a stop loss to calculate the other parameters of the trade. The low, so I'm going to put my mouse on this candle right here and then look over here at the low, what the low of the day for that day was. And that low was $55.84. I'm going to just put it below it. I tend to use round numbers, so I'm going to put it at $54.80. There's no magical calculation there to come up with that. It's just I want it below that number, and I'm looking for the next round number to put it at. That's typically how I'll do it. And you're going to go over here to this blue. This will add to the portfolio. This one adds to your watch list if you created watch lists. If you don't know which is which, just put your mouse on it. It says add to portfolio right there. And I'm going to add it to my stock-specific class portfolio. I'm putting in my stop price at $55.80. And then I'll put in I usually start with like 100 shares. And what I'm looking for here is I want my total transaction. These are kind of basic parameters that I'm looking at right now. I might get a little bit more aggressive when I believe the market is bottomed out and is trending up. But right now, I'm trying to keep the total price between about 8,000 to 10,000. Yeah, again, if it works out that it's a little bit. Well, I've tried not to go above 10,000. So, but if it's a little below 8,000 or something like that, that's fine. So I can add a few more shares. But another thing I'm looking at is portfolio risk. I don't want the percentage portfolio risk to be above 1.5%. So in other words, if I get stopped out, what this is calculating is if I get stopped out, if I hit the stop loss point right now with 100 shares, if I hit the stop loss point, I would lose about $550. I'd have $6,000 in the trade, but I'd only lose $550, which would be about 0.5% of my portfolio. So it doesn't hurt me at all, really. So so I don't want any trade that I get stopped out to end up being more than 1.5%. Now, can a stop gap down beyond my stop loss point and end up being a bigger loss? Yes, and that does happen. And it will happen. You can't prevent it from happening. But if you can keep this risk, you can afford to have one of those unusual drops happen if you're managing your risk and you're disciplined in managing your risk. You can withstand a few of those. Now, keep in mind, you're also going to have moves that go in your favor that you weren't expecting. Earnings report, the stock blew away their earnings numbers and it gaps up $50. Okay, that's going to happen too. And you can't only pay attention to the times where it goes against you and not recognize when it goes in your favor, because that does happen. It tends to balance out a lot of times. The problem is most people only see it when it goes against them, or only recognize it when it goes against them, and they think that they're cursed and it only happens to them. And no, it happens both directions all the time. So I could increase this a little bit, and so I will. I'm gonna add. Let's see what 120 shares looks like. 100. Let's try 150. Is that too much? No, that's about right. There, I've got about 9,000 in the trade, so I'm below the 10,000, and I'm still below my portfolio. I'm still below 1%, so I'd only lose $825. By the way, you got to be aware of this too. Right here is how if you did lose $825, how are you going to feel about it? Are you going to freak out? If so, then you need to drop that down. You need to get down to a lower level. Maybe you could only handle a $400 loss. Okay, then you're going to do 75 shares, and you're only going to have $5,000 in the trade because you know that you couldn't handle that big of a loss if it happened. Okay, and that's why a lot of these decisions are very personal. I can handle a certain loss Someone else might not be able to. You're going to have to get it to a level that you can handle. And then over time, you'll be able to increase that as you see success and you have confidence in your system. You can then start to raise those risk levels up a little bit. Although you don't want to ever get to a point where risking 25% of your portfolio in a trade, because you're not giving yourself a chance. You're not giving yourself much room to have losing streaks, and you're going to have losing streaks. All right, so I'm going to go ahead and purchase this. Question, stops are entered with broker or just for guidance? Well, none of these trades I'm doing in the portfolio are with a broker. This is all virtual trading on the website here. And as far as your own portfolio, it could be either way. If you know you can have the discipline to stop out at your stop loss point, you don't have to have an actual order there. You could wait until it actually drops below that area and then go ahead and place an order to stop out. But if you have a tendency to, let's give it one more day, or let's see if it comes right back up again when it gets to your stop loss point, and you don't have the discipline to pull the trigger and get out and take that loss, because nobody likes to take a loss, then I would put an actual stop loss order in. You take that decision away from you, make it automatic, because you've gotta control risk. You've gotta, if you're going to stop out, you got to stop out. And that's what I did with CF. I don't think CF is going to fall apart. I still think CF is going to go up. Let me pull that up here real quick. I still think CF is going to go up. I still think this is a corrective pattern leading to another move up. But this is where, this is a significant low right here, and we broke below it. Now, I also, like I said, like I mentioned when I stopped out, I got out of it. We were below it. I got out. Because you got out doesn't mean you can't get back in. Now, I don't want to just jump back in today because we're still below that level down here. But I could just, like I mentioned earlier, just say, okay, who knows how much further this thing could drop now that it's broken that key support level. Now wait till it goes back to a buy signal, or at least starts, maybe it moves up and then has a pullback and moves up. It's stair stepping up again. It's acting like an uptrend. At least wait till it starts acting like it wants to go up to get back in. You can get back in. You can do the same thing. Get back in, put a stop down below here, or maybe you put it down below here now because it's a little bit lower. The bottom line is there's no perfect way to manage trades. There's no magic formula that there's pros and cons to every approach. And so what you need to do is just start doing it. Just have a plan. It doesn't have to be a perfect plan, but have a plan. Then once you have the plan, you can make adjustments to it. You can try some different things, or and what I've tried to do, what I do with a lot of my trades is because I can trust myself to take a loss. I don't have a problem taking a loss. I use a number of approaches. I don't have one approach that I use. I try to tailor it to market conditions, what I'm seeing. I tailor it to, key levels on the chart that I'm noticing. A lot of times I'll put stops below the steps. If the stock is stair stepping up, I might start with a stop below here, and then when it pulls back again and moves up, starts moving up again, I'll move the stop up below that low. Maybe it's been in this trend for a while. I know Elliott wave analysis. I might say, well, that's wave 1, wave 2, wave 3, wave 4. We're in wave 5, which is usually the final wave. Maybe I'm in an extreme overbought condition, and I might use a close below the low of the previous day to get out. I might say, man, I captured a big chunk of that trend, knowing that the cycle of trends we're probably in the later stages of that. I don't want to give back all these gains I made on this last move. I'll get out on this, on any sort of bearish signal that it could start dropping. So, I could be a little bit flexible with the approach. But that takes time, and not all of you are there yet, and that's fine. Just start with an approach and work on discipline. Make sure you can stop out of a trade. Take that loss. Now, I'll tell you right now, the biggest part of taking a loss is going to come back to, in this, I'm not getting in this thing, but I'm just throwing out hypothetical here. It comes back to, oops, that's too much. Comes back to this right here is how much are you going to lose when you get stopped out? You've got to get that level down to a level that you can handle, that you're not emotional about. And I don't care what that. If you're looking at this right now, saying, "Man, if I lost $500 on this trade, I couldn't sleep. I'd be freaked out. I'd be so mad." Okay, then you can't do this trade the way it's laid out. You've got to get that. You got to find out what that level is. If you say, "Okay, I could do 500 is way too much. 200 is about my limit. 200 is there. That's it." Okay, then you're doing. Oops, that keeps moving. Let's keep that at 85. You're doing 50 shares, roughly. Let's see what 50. Well, 50 shares is still too much. That's 270. You said 200. There we go, 37 shares. That puts you at 199 if you get stopped. Now, again, that's assuming you're stopped. You're able to stop out at that exact price, which you're not always able to do. But the point is that now that's the trade you need to make. That means you're only going to have $3,000 in the trade, but that's why I can stop out, because it's like, okay, $200. I'll blow that on dinner and a movie with my spouse on the weekend. So we don't get to see Top Gun next week. Big deal. That'll be my risk. Okay, then that's where you start. That's how you stop out of a trade. The reason why people say they have trouble stopping out of trades, and how do you solve that? Well, the problem is they're buying 200 shares of the stock because they believe that trade's going to work out. There's no way this is good. I'm the master of analysis here. There's no way I'm going to be wrong on this. Actually, let's do this bigger. Let's do, because I'm really confident. I'm gonna do 500 shares, and then they get stopped out, because you're going to have trades that stop out, and they're going to end up losing $2,700. And now you're looking at that saying, "Holy crap, that's my mortgage payment. I can't pay my house payment if I lose that money." And that's when you say, "Oh, well, let's hope it goes back up. Let's hope I don't have to take that loss. Let's give it another day, another week, another month." Meanwhile, that number is going up and up and up, bigger and bigger losses, because and then pretty soon you have $45,000 in that trade, and pretty soon that's now only worth $10,000, and you have a $35,000 loss. And your whole retirement fund you've spent 20 years accumulating is gone in 2 weeks. You'll never succeed this way. But if you're wondering how do I control, so there's no magical, I don't have a meditation technique to help you accept that loss. It's too big. There's nothing I can tell you that's going to make you accept that risk, which means you better not be doing this trade. Does that make sense? So this is really the starting point to everything that you're in your positions. Now, what I've got set up on these parameters, I know I'm going way over to this. Is supposed to be a real short class and it's gone long, but hopefully there's some valuable things here that you're learning. What I'm trying to do with the portfolio is I'm trying to keep that I'm trying to keep this amount in that 8,000 to 10,000 range. Why is that? Well, again, I started with a $50,000 account. What this allows, no, a $100,000 account, excuse me, started with a $100,000 account. This allows me to be able to have 10 separate trades of around $10,000 each. So I don't have everything on one stock that if bad news comes out, my whole portfolio gets ripped apart. I can spread out risk, but I'm not willing to risk that's the amount I'm just putting into the trade. I'm not willing to risk that if I'm wrong. I want to keep that amount to that. It's anywhere from about 1 to 1.5%, but again, it just depends on. It could be below that. In this case, where I had my stop, it's below that. It's only $540 I'd lose if I'm wrong. And then you want to make sure that even at that amount that you can handle that risk. Now, the majority of my trades, I'm not going to be risking more than $1,500, which would be about that 1.5%. Okay. And then, there's other things we can do. One is we're in a bear market. I want to have more cash. I don't want to be in a ton of positions. And if I am in trades, I want to be in stocks that are going up despite the market going down. And that's why I've got a lot of oil stocks in there. So anyway, these are just some little different, and that's what I'm trying to do each week. By the way, there's a lot of trainings on this. If you're brand new, if you go to YouTube and go to Traders Pro, the Traders Pro channel, and subscribe, you'll get access to all these trainings: Elliott wave analysis, basic trend analysis, ABC patterns, Fibonacci retracements, the trade management, entry techniques, exit techniques, stop loss techniques, trailing stop techniques. There's tons of hours of training in there that you can get access to. So take advantage of it if you want to learn some of these. And then in these live classes, I'm just kind of putting all that stuff together as we're looking at this stuff. Real quickly here, I've gone way late, and I did want to. It is a stock-specific class, so we wanted to go over some specific stocks. Under oil, there's still some good oil stocks. TDW right here, Tidewater, 97 strength rank. Again, it's been at a buy signal, but it's been consolidating right through here after breaking out. Oil starts moving higher again. This should start moving higher again. That's a good pattern there. Another one I liked in that group was this Valaris, VAL, 97 strength rank. Again, it's dipped down a little bit here. And you will probably want to wait for it to go back to a buy signal as confirmation. But it's in that trend range right there. Looks like it's trending up. Under computer and technology, I don't want to get into too many computer and technology trades because I still think the market has another leg down, but the Silicon Motion SIMO 93 strength rank. I pointed this one out I think last week, but it's going to a buy signal today. This QLYS 93 strength rank. I liked, again, it had a sharp move down, but it had an impulsive up, and this looks corrective. Now, it could maybe have one more move down into here and then go. But again, we're waiting for it to go back to a buy signal anyway for confirmation. I wanted to show you, because as you're going through your list, you're going to find some stocks that, by the look of them, you can tell you don't want to be trading them. This NSYS right here, there's some signals of low. Let me switch it to candlesticks so you can see a little bit better. There's some clues here of low liquidity. Whenever you see a stock that's, look at this candle right here, it barely moved. That means there are very few trades that happen that day. But look how it gaps up and gaps down almost all the time. Gap down here, up, down. When you're gapping almost every day, that's telling you that there's not a lot of liquidity. When you have these intraday highs and lows that are really high, a lot of these really distinct tails, it's telling you there's wild price swings, and a lot of times wild price swings are because there's not a lot of traders there, and so you're having to take, you want to sell, but there's nobody to buy it from you, and the market maker's like, all right, you're the only one, so I'm going to lowball you. You can sell it to me, but I'm selling it to you down here. And then there's one other person that wants to buy it. Okay, I'm going to charge you this much because I'm the only one you're buying from. And you get these really wild. So you want to stay out of those because you don't want to be that guy that's the one guy trying to trade against the market maker. Now you can see here the volume is almost non-existent. I mean, but it'll show up on the charts. Now another thing that'll happen is that sometimes you'll run into is you'll see a stock that's been trending along, and then it'll have a huge gap up, but then it's just flat line. It's moving flat. You want to stay away from that because that is usually a buyout, meaning a company is acquiring that company, and usually they're acquiring it at this price. Let's say that was at $70. It moved right there. They announced right here they're going to buy this company for $70. It moves right to $70 that next day. It gaps right to it, and it's not going to go anywhere because that's what they're buying your shares right now because they want to control the ownership of the stock. That's what they're paying. And it's going to flatline right here. And it's going to just keep flatlining until the acquisition is done. And then your shares are going to be morphed into the new company anyway, and you better be aware of what that company is trending or how that chart looks, because that's going to be if you're going to hold on to your shares, you're going to end up, you're now going to be owning that other company's shares. So that's the big clue you'll see on there. You'll see a pretty distinct gap up, and then it'll just be moving completely sideways. Don't be jumping into that. Or the good news is that you're not going to lose money. It's just going to stay at $70. The bad news is it's not going to make you any money. And it could be that it's going to be that way until the acquisition is done, which could be 6 months or 8 months or something like that. So it's a waste of time. Now the software's done a better job of eliminating those. Early on, we had a bunch of those that it couldn't eliminate, but Jesse's done a good job of adjusting that to where you don't see that very often anymore. Sometimes you'll catch one here or there. In fact, I was trying to find one as an example to show you, and I just couldn't find one anywhere. So, but we may come across one. If I do, I'll show it to you. All right, I got to get out of here. Have a great week. See what happens tomorrow. We'll probably have a lot to talk about on Tuesday, especially ahead of the Fed meeting as well, and we'll kind of go from there. Thanks, everyone. Have a great week. Bye now.